Jeff, let's talk about what's happening in China right now. We're going to take a look at a monetary measure that's kind of, what would the word be? Technical, sciencey. It's very hard to follow. It's very shadowy, difficult to understand. Thank goodness you're here. You're going to help us. Jeff Snider, the head of global research at Alhambra Partners. And then we're going to look at PMI scores, which are easier to understand. Jeff, the article we're going to start out with is, what if CNY's backdoor still isn't a big enough exit? And this is on March 2nd. It was posted at Alhambra Partners. And Jeff, I guess it's supposed to be shadowy, right? Because this is something that the People's Bank of China is doing, but doesn't want us to know about it. Now, what is it that we see on the surface? What is it that's in popular media? And then we're going to get into what you think might be happening behind the scenes.
Well, the big discrepancy we're really investigating here is the fact that the Chinese currency has surged. I mean, it's gone almost vertical and been steadily vertical since around the end of May last year. And what that suggests is, hey, the world is getting better. The world is recovering. There's a flood of dollars heading inside into China, except the discrepancy is they're not showing up in the PBOC's balance sheet, which they really should. There really should be rising foreign reserve assets if that's what's going on in the currency. If the currency is being driven higher by dollar inflows because there are more dollars available, especially for Chinese counterparties, they would end up on the central bank's balance sheet. As you can see, before we got into Eurodollar number 3 in 2014, that's exactly how it worked. More reserves, higher China, the higher the CNY traded against the dollar, because those two things went together. Dollar inflows, CNY up, world economy good. These things all happened together. And then since really around 2013, 2014, China has experienced only outflows, which aren't really outflows. It's just dollar tightness that the authorities are trying to do their best to deal with, which we'll get into in a minute. Only that, again, you have the reverse. Not only the dollars flow out of the PBOC, out of China, suddenly CNY is no longer dependably rising. It starts to fall, except for it's been broken by these periods, especially in 2017 and again in 2020, where we're wondering what's happening. Because you can clearly see CNY rebounds, but there's no dollars flowing onto the PBOC's balance sheet. So we're left to wonder what's going on here.
Jeff, you made a beautiful graphic, but it's a little bit hard to follow. But I think it's important to just talk through it. Would you mind talking about what this is? Because I think it's very impressive, and it kind of gives us a sense of what should be happening. Is that right? And then we're going to go through this article and look at this graphic again as to what is happening, or how different, channels are being cut off. But what are these channels? What are we looking at?
We'll start with sort of the pre-2014 framework. And what it really was is that, look, dollars wanted to find a home offshore. China was a good home for dollar investments because the Chinese wanted the dollars. Banks that had dollars were looking for places to put them overseas, rapidly growing economies, so they were thought to be low risk, high return. And so the Eurodollar market supplied endless, boundless sources of dollars for Chinese purposes. But the way the Chinese system works is that, look, the CNY does not directly float against the dollar. It's a limited managed float. So that means that there are a daily basis. The People's Bank of China is, taking in a lot of the dollars that show up onshore. And so it's some of the dollars end up in the Chinese banking system. Some of the dollars end up in the PBOC's balance sheet, which then the PBOC invests in US Treasuries. So there's sort of a harmony here. More dollars go in, the more we see it on the PBOC's balance sheet. And since foreign reserves are the largest proportion of assets on the central bank balance sheet in China, that's also the basis for internal currency, which is the right side of the graphic that you're showing. Because the more foreign assets that are in the PBOC's hands, the larger the PBOC's balance sheet becomes, which means more liabilities. And on the liability side, obviously, is bank reserves and physical currency. So the more dollars that come in, the more good money in China, basically. And we know that it's working the way it's supposed to be working because they end up in the PBOC's hand, as well as CNY rising against the dollar.
I think an important point here is that these offshore Eurodollars eventually do support internal currency. That's very important because in 2013, that all changed and CNY started to head lower. And this is the graphic that you show us. And so what is happening here?
Yeah, and so it's really, why is CNY falling? And that's because the dollars no longer are flowing into China at the same rate that they were before. They've become more expensive or reasonably less reasonable in terms of what they're being offered into Chinese hands. So for something changes in the Eurodollar market, which we saw throughout 2013, we saw all sorts of warning signs that dollars were becoming scarce and tight on global markets before we started CNY actually falling. And so in 2014, now we have the Chinese currency dropping rather than rising, and which meant that the Chinese were not getting enough dollars. So what the PBOC decided to do was it had to intervene somehow, because the bottom left part of the chart here is really maybe the most important part that's most misunderstood, which is that China needs dollars. And why do they need dollars? Because they participate in a global marketplace, and the U.S. dollar is the denomination for participating in global trade, not just merchandise trade, but also financial flows. It intermediates merchandise trade, it intermediates financial flows all over the world. So the U.S. dollar denomination supplied by the Eurodollar market and recycled and redistributed by the Eurodollar market is this global reserve currency system, which everyone participates in, whether they want to or not. So confronted with a dollar shortage or a dollar shortfall, the PBOC had a choice, which was either let their corporate sector default on their dollar loans, which would have been catastrophic. They would have been sort of like an Argentina scenario, except for China.
And is that
they decided they were going to sell some of their foreign reserve assets and supply the dollars the Eurodollar market would not.
And is that what we're seeing in this second or third version now, where the lower left is, what would we call that out? More transparent?
Yeah, so what we're seeing is that exact workaround. But there's a consequence and a downside to this bypass. If the PBOC is suddenly supplying dollars that the Eurodollar market will not, it has to sell its foreign reserve assets to liquidate them into some sort of usable form, and then transfer the cash to their, either their banking system's hand or the Chinese corporate sector's hand. We don't know. That's the other point here, is we don't really know what the PBOC is up to, because unlike central banks around the rest of the world who are committed, at least in principle, to transparency, the communist Chinese are not. They kind of like the fact that they operate in the shadows. So we don't really know what the PBOC is up to, except in this case, we do know they were selling the reserves, because we could see the reserves disappear from their balance sheet. We could see the reserves disappear from safe's custody. So we knew that they were selling reserves and inferring that they were supplying dollars because of the dollar shortage, as CNY only fell further, and further.
And now we come to the title of your piece, that there's a
before we get there though,
yes.
remember the downside of doing this. The consequence of this is like sort of quantitative tightening. We go back, if you're selling reserves, that means you're shrinking your balance sheet as a central bank. And if you're shrinking your balance sheet, that means you're not only shrinking your asset side, you're shrinking your liability side. And so you have to curtail currency growth, physical currency growth. You have to shrink the level of bank reserves, which you're showing here in the chart, this chart right here. So it was a monetary contraction that began in the Eurodollar market that the PBOC then chose to import and internalize in its RMB system. And they did so because they thought, look, we'll do the dollar bypass. It seems like it might work. This might just be a temporary problem. We just need to buy some time. And we'll offset the contraction in bank reserves in particular with, reserve requirement cuts and other internal things to try to boost RMB liquidity. And yet it didn't work. It didn't really happen that way. And instead, the consequences were pretty severe. And at the end of the day, the Eurodollar problem wasn't a temporary one-off thing.
Right. I just pulled up a chart that shows the currency being issued and the year-over-year growth, and we can see on the bottom of that chart how much weaker, and that's terrible. Can you imagine for a terribly indebted nation to then issue less currency? It's very deflationary.
Well, also in an economy like China, systems like China, a hand-to-hand currency is actually a much bigger part of the commerce structure than it is in most Western countries. So curtailing physical hand-to-hand currency availability is an enormous constraint. Mm-hmm. So you kind of, in some way, you have to sympathize with Chinese central bankers, because they're basically saying, what is our least worst option here? Do we put the brakes on the internal monetary growth in hope that we can offset it with RR cuts and things like that, in hopes that the dollar system, this dollar shortage goes away in due course? Or do we just, do we do something else? Something like we talked about before, last year, the Brazil strategy, where we do even more clandestine stuff.
But guess what, Jeff? We had moments in 2017 through 2018, and more importantly, we have them right now, where the CNY is rising against the dollar, and therefore the money should be coming in. At least that's what you're showing on this graph, is you're illustrating to us what is missing. And so I guess it's not showing up on the balance sheet of the People's Bank. Therefore, there must be some clandestine backdoor, who knows?
Yeah, so there's something else going on here. That's really what we're saying, is that's the point of the piece, is that, look, CNY is up, but the dollars are not showing up in PBOC's hands, so something else is happening. It's not dollar inflows, or at least it's not dollar inflows as they were before 2014, the normal course of Eurodollar expansion leading to investments and dollar availability in China. Something else is happening. And because the PBOC isn't going to come out and tell us what's happening, we sort of have to go back and try to piece together what could be happening. And to me, the most plausible explanation is about this dollar backdoor. Now, what you're getting to here is what other people are saying. So why don't you scroll back up to the other one, the backdoor one. What that really is, instead of, up a little bit further, right there. So instead of outright selling U.S. Treasuries and foreign reserve assets, which reduces the asset side of the balance sheet, they might have undertaken what we've called the Brazil strategy, which is employing derivatives, forwards, maybe even term repos, any number of things, where instead of liquidating assets and supplying dollars, the PBOC is actually borrowing dollars from the Eurodollar market, because the PBOC can go into the Eurodollar market and get dollars that the market probably wouldn't supply private corporate Chinese counterparties. So essentially, it's still the bypass, but it's a bypass into the back door in a different way, and it wouldn't alter China's balance sheet. And I think the primary evidence for this particular scenario is the fact that, especially over the last couple of years, the level of foreign reserve assets reported by the People's Bank of China has been almost completely flat, as if they're managing or targeting a specific balance, which is sort of a side effect that you would expect bureaucrats to use to guide themselves in this sort of PBOC clandestine backdoor type of activity. They're entering into forward contracts or giving their private banking system forward cover to go on to the Eurodollar market and subsidize their borrowing through this backdoor system. And all the while, the Chinese, instead of managing their currency, are targeting their level of foreign reserves to tell them how much they should be doing.
And then I had skipped ahead a little bit too far to this graphic here, where you cross out some of these channels, and you were saying that this is what is assumed is happening in the popular press?
Yeah, some people have said, well, okay, yeah, we see that there's no dollars showing up on the Chinese People's Bank of China's balance sheet, but maybe the dollars are showing up in China. They're just not being taken in by the central bank. In other words, the dollar inflows are taking place, but they're not. They're being purposefully diverted, or being allowed to be purposely diverted into the banking system's hand, or the banking system is keeping them offshore rather than importing them and using them internally, or any number of things that just doesn't involve dollars ending up in the PBOC's hands.
Jeff, though, we do have a little bit of a problem, and let me get to it. I suppose I don't need to show it on the graph, but the point is that the currency has paused in its appreciation sometime around early January, and that's no coincidence. We've seen a number of things happen since January that indicate the reflation is struggling.
Or something has changed. I think that's probably the best way to put it. Is we go back to early January, we see a whole bunch of stuff where we think something has changed here. especially going back to, early November, the last couple of months of 2020, it seemed like dead set, unequivocal reflation in a lot of things, especially commodity prices, inflation expectations and things like that. But then, the dollar too, between early November and sort of the end of the year, it started falling again as well across a broad range of currencies. But then early January, now the dollar catches a bid. CNY no longer is rising. T-bill rates plummet. I mean, there's all sorts of things that are starting to say, yeah, if you look at the long end of the Treasury curve or, 5-year tips, inflation break-evens, it looks like reflation has continued undeterred. But now we're starting to see some dollar indications there's very reminiscent of early 2018 again.
It's not just China. We see it, as you point out in another article, that the real has peaked and tipped over.
Yeah, any number.
Same time period.
It's actually a broad. If you look at the trade-weighted U.S. dollar, for example, not just the trade-weighted emerging markets, but even the one that includes the euro. The euro itself has traded differently since around the same time. And in fact, if you draw a chart with the euro and CNY together over the last 5 years, they correspond very closely. Not exactly in the short run, but over the long run, there's a very good correlation. So since the early part of January, we're seeing some things that say, okay, the PBOC is doing things in its back door, and that has some other kinds of consequences too, because as we know in economics, there are always trade-offs. If the PBOC was going to do the original bypass, which is to sell reserve assets, the trade-off was internal monetary constraint, which was a big problem in 2015 and 2016. So if the PBOC instead says we're going to target reserve levels, then there are trade-offs to that as well, which is if things start to go awry, as they did in early 2018, you really don't have much room or much margin for watching essentially helpless as the currency turns around and plummets again, which is exactly what happened in early 2018. CNY that had looked for a very long time as if it was unstoppable on its rise again, its resurrection from its depths of late 2016, all of a sudden turned around almost 180 degrees and began to plummet, a breathtaking plummet that brought it down to, essentially a multi-year low by 2019. So if the Chinese are doing the same kind of thing now, and we're starting to see some risks rise, as we've been talking about, not just specific to China, but globally, dollar system indications of illiquidity rising in many places, what is CNY's vulnerability with essentially the naked, hollow backdoor in operation over the last 7-8 months?
And believe it or not, Jeff, our most popular audience or largest number of listeners, according to the statistics, is not in China, but in the United States. And so people in the United States might be saying, China, well, I don't care. What does that affect me? And I heard that their PMI didn't do so well. Guess what? Our PMI did fabulous for the same time period. So too bad, China. We are decoupling from you. And you talk about PMIs, China, the United States, and more importantly, decoupling, and that this isn't the first time we've been through this story in an article called There's Two Sides to Synchronize, posted on the 1st of March at Alhambra Partners. We don't have much time in this section, Jeff, so we won't get into the nitty-gritty of it and go through each of the numbers, but basically, decoupling, the PMI in China's tipping downward. The PMI in the United States is surging higher. What has this happened before?
Well, it's actually a regular occurrence. In fact, it's almost it's perfectly predictable. The Chinese economy seems to tip downward before the U.S. economy by a matter of 8-9 months, maybe to a year. So it's not at all unusual to see those two diverge. In fact, it's practically historical. That's kind of how it happens. And really, reflation and decoupling go hand in hand. But the point of that is, though, when we start to hear decoupling when in the reflationary context, it's usually when reflation is starting to die out and change over to the next Eurodollar global dollar shortage stage. So the fact that we're starting to talk about decoupling already, at least, initially, this whispers of decoupling, maybe there's a stumble in China. By the way, today the Chinese authorities announced that the their official GDP target for 2019 or 2021 is going to be just 6%, which is a lot less than maybe a lot of people were thinking. So again, we're starting to see maybe things are not progressing in China as much as maybe many people had been expecting or hoped. And what that leads to is that Chinese go first. If the Chinese economy starts heading toward a downturn, you can pretty well expect that eventually the global economy will resynchronize in that direction, just as it had done in 2018. Chinese PMIs were sinking early part of 2018, while US, especially the ISM, was soaring right through the middle and on into early autumn, before eventually the US started to catch the same disease that had already ravaged the Chinese system.
That's right. In your article, you go over how this happened, and you give numbers and dates, how it happened in 2010, 2011, Eurodollar number 2, Eurodollar number 3 in 2014, Eurodollar number 4. And at Eurodollar number 4, well, it's tough. When you're out there in the public and you say things, you're going to get tripped up. But here we have Mohammed El Arian saying, in addition to highlighting the strength of the U.S. economy, because the PMI was so strong, this also points to a more general theme of divergence in advanced economies, economic performance, and policies. Well, that was in September of 2018. The divergence wouldn't last very much longer.
Yeah,
Jeff,
and that's the overall point. Reflation and decoupling go hand in hand. This has happened every time, except when you start to hear decoupling, that already means something is already going wrong.
It's a trigger warning, but in a different kind of way. Jeff, just tell the people the PMI that came out in China right now, it was a 51.4. And people, if they hear that, they'll say, that's above 50. I know if the PMI scores above 50, that means expansion. Therefore, China's expanding. Good. Jeff, where does 51.4 rank in modern Chinese history?
I believe it's the third or fourth lowest in their entire history. So it's not a good number by any stretch. Nor is the slope of the descent. It has lost something like 6 points in just 2 months. So what it indicates, and this is the non-manufacturing PMI put out by the National Bureau of Statistics, which is the official government PMI, which suggests the internal Chinese economy has lost a significant amount of momentum, almost more momentum than was lost in early 2020. So it's a warning sign that, hey, something's not right in the Chinese economy right now, and it's not COVID.
That's right. The other times that this 51.4 was reached or breached was February 2020 and November and December 2008. Awful, awful months. Jeff, that's really bad news that it's the non-manufacturing PMI that's so bad, because that 6% number that you mentioned for their GDP, that is based on the assumption that consumers are going to step in and spend some of the savings and some of the pent-up demand from the previous year. And therefore, the Chinese government won't have to be pressing the pedal to the metal on their infrastructure and real estate spending. So if this PMI is signaling that the people in China are not really feeling it, consumption demand, then it's possible that the government may need to do a U-turn and go back to the fixed asset investment spending and raising their debt to GDP levels on unproductive investment just to keep the lights on. I know that they're counting on consumers to carry this year.
Which they're not going to do, which they've already stated. Their no sharp turns policy essentially says, this is it, folks. What you see is what you get. So if the China's going to do at best 6% GDP growth this year, which you and I were talking about earlier, they're going to hit 6% because they can do that. They can make their GDP whatever they want. But as we were saying, will it be a legitimate 6%? I have my doubts. And the downstream consequences of that for the rest of the global economy are much more severe than maybe most people anticipate, especially in the United States, because we think of ourselves as, an island unto its own economy, when that's not really true. So if the Chinese are in a situation where they're basically telling us at the outset of 2021 that things aren't going all that well to start with, and we don't, even when they were going well, we didn't expect them to be all that well to begin with for this year. You can understand why there might be growing risks being priced into these various markets around the Eurodollar world.
Let me just tease out one word that you mentioned there. You said that will it be a legitimate 6%? And I think that we both agree it will be a legitimate 6%. They will have 6% more economic activity than they had last year, but it'll be unproductive activity. Do you agree that that's what we mean by legitimate? It's not that they're lying, I think.
There's an artificiality to it, on top of the fact that 6% after last year means you're 2 years in a hole rather than getting back out of the one that you just you're trying to dig yourself out of. So 6% in 2021 after doing only 2 or 2.5 or 3% in 2020 means you're even further behind where you are supposed to be according to Western economists and Western expectations. So the Chinese are only getting further and further behind, which causes, again, enormous amounts of downstream problems through that ripple through the rest of the global economy.
Western economists and Western expectations are for some sort of inflationary fury to take place right now. And I wonder if the Treasury Department may be picking up the phone and calling the central bank, the Fed, and saying, we don't like where these Treasury yields are going. Maybe you can do something to take care of that. Maybe some yield curve control. That's kind of what we're going to talk about in part 3. So, dear audience, stick around for that.